The daily edition of Market Wrap with Mo Ansari.
Brought to you by Compact Asset Management.
Providing proactive portfolio management and world-class wealth management solutions.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. Today on our guest line is Ms. Christine Richard, reporter from Bloomberg News and author of Confidence Game, How a Hedge Fund Manager Called Wall Street's Bluff. Ms. Richard has covered the financial markets for 17 years from Washington, Hong Kong, Singapore, and New York. Her work has been recognized by the New York Press Club and the Newswomen's Club of New York. Ms. Richard, welcome to Market Wrap.
Thanks for having me on.
Let's talk about your book. Interesting book. It was really interesting how a hedge fund manager ran around and tried to tell everybody that this house of cards is going to come down. It tells us the story of how he tried to warn how the bond insurance business, the MBIAs as we call them, why did no one pay any attention to all of these warnings?
That is sort of the story of the book that I run through. And, you know, he does take his concerns to just about everyone, to the press, to regulators, to rating agencies. And at the point when he starts raising questions about this company, it is AAA rated. It's guaranteed hundreds of billions of dollars of securities. And you almost wonder, was it too late from the beginning? I mean, you know, to try to raise questions about a company that had become so systemically important. I think people didn't want to believe it. They looked at the AAA rating and they said, well, look, 3 rating agencies have signed off on this, and you're a hedge fund manager who stands to make a couple of $1 billion if you can destabilize confidence in the company. So we're going to listen to the rating agencies.
So they just, and a lot of people branded the book is about Bill Ackman and branded him as a fraud and put him under investigation. Is that true?
Right. After he issues a research report, this is back in 2002, and the title of the research report is MBIA AAA, and he raises a lot of concerns, and clearly his conclusion is it's not. And within a few weeks, he's being investigated by the SEC and by then New York Attorney General Eliot Spitzer, and the company had argued to regulators that he was trying to, stir up false concerns that would then destabilize the company.
And he would benefit from it being short in the market or picking up short positions in the market, the positions that make money as the markets go down.
Exactly.
Let's move forward a little bit and where we are now. This week we've had the highlight of the Goldman Sachs testimony. We've had the financial reform, and that bill failed. It did not seem that both sides could not agree that we needed reform. Would you disagree with that we do need reform? And in this bill that is pending in Congress right now, there's no reform of the credit agency, is there?
Right. I mean, I think what the situation with Goldman has maybe underscored here is that before we figure out how to change the system or implement new regulations, I don't even think we have a good understanding yet of exactly what was being done on Wall Street. I mean, I think this Abacus transaction is news to most people out there. They had no idea that there was such a thing as a synthetic CDO and that these CDOs could be constructed and then bet against.
Do you think we will ever get to the bottom of this and the truth of this? Because here we're sitting 2 years later after the fact when millions of people lost their jobs, millions of people lost their homes, and now we're sitting here saying, okay, let's find out who stole the money and where did it go? And, why did this? Do you think it's a little late and if we'll ever get to the bottom of this?
Yeah, I mean, I think we're starting to with looking at this Goldman deal and trying to understand, is that a reasonable thing for an investment bank to be engaging in or not? And, there has been a lot of concern about short selling or betting against the market, betting against, mortgages, betting against companies. But this book, Confidence Game, I think is maybe the flip side of the story, which is at least if you have people betting against something, you have a healthy market for skepticism. I mean, people can make a lot of money if they can poke holes in these problems. And we needed more people who were skeptical of what was going on in the housing market and willing to talk very publicly about it. I think it becomes harder to judge when someone takes a short position and then just sort of is quiet about what they see, the problems out there.
Selling shorts by itself is not bad. I think we need to have is having the checks and balances within the system. That's what we need to have. And just some more regulation or something where we know what these CDOs and all of these Wall Street firms are doing, instead of having their own little exchange set up in New York, which is nobody knows exactly what the value of these CDOs and all of these derivatives is. Put them on exchanges where everybody knows what the value is on a daily basis.
Right, and in researching this book and going back to 2002, that's one of the issues that Bill Ackman raised about this bond insurance company. He said, look, they're getting into the business of insuring CDOs, and one of the problems that I see here is that I think these CDOs that they've insured have fallen hugely in value. They seem to be very volatile, and these insurance companies are not supposed to be, they're supposed to be insuring very stable, secure securities like municipal bonds. And, in some ways that debate was cut off by regulators themselves, who said, well, wait a minute, you can't go around saying that a company is not reckoning fairly the value of its securities. You may destabilize them. So I think it's an interesting lesson that we would have been much better off if these debates had been public instead of having been shut down by people saying, no, we can't. Short selling is always a negative.
You also, in your book, talk about credit rating agencies such as S&P and Moody's assigning ratings before the crisis. They were grilled on Capitol Hill last week about their role in the crisis. Do you think changes will be made in the way credit agencies rate bonds?
Well, I think already they are less inclined to give AAA ratings. I think they have certainly learned a lesson in one sense. But you wonder if down the road, unless some changes are made, will they find themselves once again being convinced by Wall Street to give overinflated ratings to bonds? I mean, one of the persistent arguments people make is, well, why not have investors pay for credit ratings instead of issuers? And that seems like it would go a long way towards solving the problem.
That's exactly it, if we can fix those credit rating agencies. Goldman Sachs officials testified on Capitol Hill. What did you take away from the testimony, and what is your overall feeling about the Goldman Sachs case?
I think mostly it is just kind of an airing for the American public to see this is what goes on Wall Street, and, it's frustrating that people didn't have a better sense of it, and I suppose it takes a blow-up before you can focus people's interest on derivatives and hedging and this kind of thing. But I think it's mostly just a learning experience, and people have to kind of judge for themselves, is this a positive thing?
One more last question, Christine, that I wanted to ask you. Where do you think we're headed as far as this reform goes? You've looked at all of these issues that we've had with this. You've looked at how the credit rating agencies just everything was AAA. They were being paid by the people who wanted their credit rated. And so the better credit rating they gave, the more they got paid or something like that. I don't know if that was but they had to give good ratings, otherwise they wouldn't get paid. Is there an inherent conflict of interest there that people who are getting their stuff rated are paying for the services?
I think that is likely, and the credit rating agencies also are in the business of assigning ratings. They're not government agencies, and in a way, the more debt that's created and the more creative that debt is, it's very positive for the rating agencies. I mean, companies are able to take debt off balance sheet and set up special purpose vehicles and conduits and CDOs, and that's very profitable for the rating agencies because it allows the society to have ever more debt. I think if something is so complicated that an investor can't dig into it and understand it themselves, then that's a potential problem. If they sort of have to outsource their understanding to a rating agency, and that agency is in the business of giving credit ratings, in some ways they're giving up their responsibility as investment managers, right? I mean, these people are paid very well to understand the risks they take.
Right.
And hopefully that happens more in the future.
Ms. Richard, I want to thank you for taking the time out of your schedule. Great book, and being with us today. I appreciate your time.
Great, thank you.
That's Christine Richard, author of a great book, Confidence Game, How a Hedge Fund Manager Called Wall Street's Bluff.